Hi there, everyone, and welcome to this month's edition of OnTrack. It's the 19th of December. Dare I say it, 6 days away from Christmas, and I'll just start by wishing everyone a great Christmas, New Year. Hopefully you get a break or enjoy family, friends, whatever is working. So this is recorded on the 19th of December, as I said. The performance numbers to the end of November, all the news up to the minute. And as usual, this is a recording for the clients of McGregor Wealth Management, particularly those that use our care investment process. Anyone else listening, please feel free to do so, but you should seek out advice before acting on anything we talk about. We're going to cover the economic news. It's still been the same sort of news around inflation, interest rates, although it looks like we've seen a great rally towards the end of the year in the markets. So it looks like the markets are voting that the inflation cycle may be nearer the end. We'll talk more about that. We'll also dive in, as usual, to what's happening with property and share markets in Australia. We'll reflect a little bit on the year that was and think about what might be happening for the next year and put it all into perspective. So firstly, in terms of the news highlights, we saw this strong recovery in November and then further in December to the point where we're almost back to the year's highs, and I'll talk through the exact numbers shortly. Part of that was driven by this typical scenario where we had bad news, which is the Australian economy slowing down. But bad news is good news because that means the mission of interest rates is working. So both the Reserve Bank of Australia and the Federal Reserve in the US held their cash rates, and they've got no sign. And while there's no real sign of easing for a while, people are starting to ask the questions. It's highly likely the Fed will ease rates before Australia, but many leading economists and predictors are assuming we get some rate cuts in Australia in the second half of the year. Time will tell. And the economists, as usual, haven't got it right all the way through. So we'll see, but fingers crossed. But some good growth in US stock earnings in the September quarter, 3.7%. That's good news because that's in a backdrop of a slowing economy with interest rates biting. So the health of companies looks good, which augurs well for as we come out of the inflationary high interest rate cycle, and hopefully that will rebound. So it's looking more and more likely like a soft landing. Soft landing is just where we've had a slowdown, but without causing any major recession. And there's a slight risk of a minor recession, but it would be very, very modest, if at all. Based on the numbers at the moment. Of course, these things can change. We've got continued conflicts, but they seem to be not impacting on markets. Markets, as they always do in wars, start to shrug off the fears. There's still a little bit of impact in the oil price as shenanigans in the Middle East can very quickly affect oil prices, but nothing too major on everything else. And that chart down the bottom there shows the synchronized falling of inflation around the world. Australia was slow to get inflation. We were slower than the rest, and we're slower to be coming out of it. We're already seeing countries like Japan, UK, etc., and Europe is now well and truly down to 2%, as is Japan. And the US is also into that sort of 3% sort of range. So Australia's a laggard there. We will actually import some of that disinflation. We've still got a few lingering worries around wages going up and whether that comes into inflation, but less and less likely. While there's still a remote possibility of one more increase, it is seeming more unlikely, and the world's starting to think about drops, and hence the run-up in shares, which I'll talk about. Cash rate unchanged at 4.35%. Bank bills barely changed at 4.36%. But the big move for the month was 10-year government bond yields down about 0.5% from about a month ago exactly. That had already started when I recorded this last month. Why that's important news is that is what we call the risk-free rate of return. So 10-year government bond yield is the risk-free rate of return. So when it gets lower, people are happy to pay more for shares and property. And when it gets higher, they're happy to pay less for shares and property. So a lowering of that rate is good, and that's what's prompted the share market to have this run at the moment. Aussie dollar fairly stable after coming off the lows of around 63 cents, still about 67. As I speak, we haven't had this month's number for inflation, but the number that came out after last month showed the continued decline. Hopefully the next one that'll come out in the next week will show us closer to 4, and that will be an indication that we're heading in the right direction. As I said earlier, the US around 3.1% now inflation. So out of the crazy danger zone. It'd be nice to see it into the 2 to 3% range. And it's actually there in the States if you exclude shelter, which is rental. The US, like Australia, has an increase in rental over the last year to 18 months. And that's still in those numbers. So if that just levels out, other things being equal, the US is into a pretty comfortable level. Now, lots of things can happen, but looking okay. Mortgage rates, obviously, relatively unchanged. There's still the odd person trying to get a decent rate out there. So some of the bargain hunters can find 5.8%, but the typical rate is now about 6.24. I note Macquarie pushed that rate up about 0.1%, while pushing their term deposit rate down about 0.1%. So that's good for their profits, not so good for the customers, but it's a fine-edged sword, and we all own Macquarie shares effectively and all the big bank shares through our super funds and other investments. So let's dive in. The care returns. So this is to the end of November. So the end of November was a solid month. We see that international equities jumped 7% in the month in Australian terms. Aussie equities about 4%, high growth portfolio about 5%. Now, it's actually been stronger in December. So we're going to see another big month in December, which means we're going to finish the year well. And the yearly numbers were looking weak just last month. They're close to 4s and 5s. They're probably going to finish in the 7 or 8s, which is bang on budget, but there's still a week or so to go. So we'll see. Longer term returns, very much within the budgets that we aim for, the targets that we aim for. And they're not really targets, but more assumptions that we know if they hit, you'll achieve your goals in terms of the plans. So I won't dive too much into that. I will have a look at sort of the last 2 years, and this was sourced from an article that came out of AMP, but it was a good summary of where we've been the last 2 years. So 22 calendar year was a pretty negative year. International shares were down around that 12 to 18%. Aussie shares were only down 1.1. It was a terrible year for bonds. This was the year bondholders who held what they thought was safe assets lost anywhere from 10 to 15%, depending on what they held. It was a terrible year because interest rates were rising. It was a terrible year for commercial real estate around the world, and not so bad for it was quite okay for property. 2023, almost the opposite. So international shares that had lost all their money, then got it all back. Australia up to the end of up to about now. Well, sorry, up to the end of November was up about 5%. It looks like we're going to finish the year at 9% Aussie, 9% sort of global as well. So if things stay the same. So ironically, after all that volatility, the year's going to end up pretty standard in terms of returns, which is such a good message once again that the patient are rewarded for their patience in putting up with the short-term volatility. So if we look ahead, what are some of the headwinds and tailwinds we're going to see as far as share markets and other markets are concerned? In terms of the tailwind, so the thing that will help, inflation looks to be moving lower. The war seems to have been won. Although I'd put it as a headwind as well, in that if it doesn't fall as fast as we'd like, we may get some lingering doubts of the market. Pretty much all these headwinds will cause volatility. In other words, the markets go through their mixed emotions of thinking, yep, it's all good, then, oh, hang on, no, it isn't, back and forward, and which is always the short-term volatility. But the possibility of lower interest rates, excuse me, will be very supportive of share market and property markets. So as those 10-year bond rates move lower, that means people are willing to pay more for shares and property because they're getting less return on their bonds. So that's going to be positive for the share market next year. There's still some lingering chance of slowdown or recession. As we see in Australian economies, not growing much at the moment. That's okay. That's what's expected when we go through a period like we've just done. And there's still some chance of recession, although not probable, but possible. So if we get rate cuts, that's going to do a number of things, as well as building confidence in those valuations around shares and property. It also frees up money that can be spent, which stimulates world economic growth. So the rate cuts are key to starting the next cycle and getting the world growing well. And that, on top of the strength of the company profits that I talked about, would do well for company profits as well. Lower rates for them means lower borrowing costs, but it also means consumers have more money in their pocket, which means it's good for profits as well. Some of the other tailwinds, and keep in mind, some of the other headwinds, keep in mind, it's the headwinds we don't know about that always cause the most damage, like COVID, but ignoring the ones we can't even conceptualize. The biggest headwinds at the moment are the continuing wars / geopolitical events, although they're not having much impact on markets, as I said. And it's going to be an interesting year in the US. We've got an election next November. We've also got the debt ceiling will probably hit a few times, both in the new year and then later on around May. And that's going to see the two political parties there play games and posturing. But as we've seen over the last 10 years now, the debt ceiling always gets resolved, but it will cause short-term volatility. So it's funny, we're looking like we're going to end up, if things hover around the same, with a pretty textbook year, actually. Bond rates at 4.5%, shares at sort of 8-9%, almost exactly what we assume. And next year, looks like it could go really well. But as always, it's the things we don't know about which cause potential downside or upside. So you can see here, I've highlighted, this is the last 20 years, and it highlights very much, as always, that wall of worry. And we get these valleys of fear. The current one, inflation, looks like it's completing. I printed this, I put this in about 2 days ago, but we're almost up. I'm looking today at the share market. We're tantalizingly close to the high of this cycle. And that would mean we would have filled in that valley. And this ignores dividends. So all during that time, we've had dividends as well. So we'll see where that goes. And there still may be some weakness, but it's a great way to finish the year. Certainly greater than when we were sitting in the middle of October at a significantly lower than where we are today, about 10% lower. So patience once again rewards those that were patient, well rewarded. And you'll see here, the top left, a dotted green line was the yield curve on bonds last month, and the blue line is the yield curve this month. Let me explain again what the yield curve is. Across the bottom, it has the years, so a 10-year yield at the moment at about 4.1%, and across the top, across the horizontal vertical scale, it has the interest rates. So it shows what's happened in the last year. We went up and we came down. That's kind of crisis alert, then crisis averted is the message. Same in the States. We're back to where we were a year ago after going up. That caused the doubts and the negativities. And now that's crisis averted, so on with it. And you'll see where we've settled is quite interesting. In Australia, about 4.1%. In the States, about 3.9% bond rates. And they're neither low nor high in the context of the last 25 years. The first half of that was higher, the second half lower. So where will it settle? No one knows for sure. But if we do get inflation into that mid-twos, then we could be looking at 10-year bond rates of closer to 3%. And that extra 1% is very positive. That extra 1% drop is very positive for share markets, all other things being equal, which of course they never are. But yeah, a reasonable backdrop going into the new year. This is just the long term, and the market has done a typical wall of worry this year, and great for those that were patient, that were persistent in their dollar cost averaging and patient in their rebalancing. And I'm not going to pause or talk about the downturns. But needless to say, our dial at the moment is firmly placed at number 7. So we think the market's fair value. So even though the market's jumped nearly 300 points since I recorded this last month, we still think it's fair value because it's been accompanied by a drop in interest rates. So that's a key factor once again in the valuations. So because interest rates are lower, that easily justifies the current levels. For now, and who knows, interest rates could go higher, but it's not looking likely at the moment. So in terms of our method up, the one I've highlighted today is just this focus on performance, particularly short term. Well, we've seen the volatility that we've had in the last 2-3 years. Anyone that gets worried about performance and starts to change has missed out on the inevitable recoveries. So that short-term focus on performance, always costly. That's one of the reasons that the Delbar study consistently shows that the returns that investors get very much are under the returns that their investments get if they just leave them alone and polish carefully, but not crazily. So once again, I'll reinforce that with a behavioral bias. So recency bias is just where we tend to overweight the current news and events. So we focus too much on what's going on now without putting it in the bigger perspective. Like I show every month in that wall of worry, all those fears, we forget about them. So what we're going through at the moment is relatively minor in a historical sense. It's not one of the major things, but the errors that people tend to think that the information coming out right now is more important than it is, and that leads to bad decisions for many, not for our people. In terms of the highlight here about our 4 pillars, the beauty of rebalancing. So let me give you an example. For many of our clients, our retired clients, we keep at reserve level. Reserves are just their shorter term investments that aren't as volatile. We keep that around the 2 to 3 year range, depending on their personal circumstances. So in the middle of October, the ASX 200 was down to 6,800. And we were telling people we're not going to rebalance now. We'll do it when the market gets to 7.4. So the market got to 7.4. We had no idea it was going to get there that quick. And we don't need to know. We just need to know that it probably will. So instead of rebalancing at 6.8 when our reviews are held, by rebalancing at 7.4, that's a 10% increase in the market. So for people that were rebalancing to the tune of $50,000, that's a $5,000 gain. For people that rebalance to the tune of 100,000, it's a $10,000 reward for that patience of doing it when we schedule it rather than when the reviews are held or when the money's needed. So that's a key part of our process that continues to add value. Aussie share markets, you'll see this chart here, and yeah, I did this 2 days ago, so it's actually gone higher since then. We're approaching that peak of about 7.5. Yeah, and here we were at the end of October. So when I was talking to you last month, reporting on numbers at the low for the year, and who knows, we could go from the low from the year to the high from the year in the next week. We will see. There's obviously a week still to go. Markets go to sleep a bit at the moment because lots of people on holidays, etc. But it looks like we're going to finish the year strong. Ironically, at the end of November, we were showing 1% for the year, but as I said, right now it's going to show more like 9%. And the long-term returns here, beautiful. That's the growth. The bottom right is a growth of $10,000, so up to around 23, 24,000. So Aussie shares do well for us over the long run. And as do US shares. In fact, US shares over the last 10 years have been the biggest contributor to the returns of all our portfolios and for most portfolios. Solid year, 13.78%. That's going to finish up closer to potentially 19, but still reasonably modest. So you'll see the recovery there is solid but not crazy, and you'll see that spectacular return in the last decade. $10,000 turned to 58,000. And when you look at the top 10 holdings there, you'll see those mega companies: Apple, Microsoft, Alphabet, which is Google, Amazon, Nvidia, Meta, which is Facebook, and then good old Warren Buffett and Berkshire Hathaway and Tesla. So great. And those companies, those big mega caps, have delivered most of the return this year. So for lots of smaller companies, they haven't delivered returns up to the end of November, that is. They're fast catching up, which is part of that increase. So on to global leaders, once again, the top 100 companies in the world. So some of those same numbers, but bringing in some others like ExxonMobil and others. Yeah, another spectacular year, 21.44% on that. And over the last 10 years, 10,000 to 48,000. So it really has been a driving engine and will likely continue to do so. Small cap shares, a bit like the Aussie market, have been low up to November, but coming up towards the end of the year as well. Highly important. These were our best performers just 3 or 4 years ago in the lead up to COVID. And hence the reason why diversification is so important, because the lead changes. You'll see that downturn in small caps before the increase, but still really, really solid returns over the 10 years there. And emerging markets have been the laggard for the last 10 years, with returns of only 4.5%, mainly driven by China getting a bit over regulated, which took the heat out of the Chinese equivalents of the big tech companies. So China has similar companies to Facebook and Amazon, and they had done spectacularly well, but they'd come back as China flexed its muscles and controlled their economy a little bit more, which always puts the market at a little bit of unease. We expect emerging markets to do well in the long run, but as always, they're highly volatile. And the Russian-Ukraine war has affected that as well as other things. So, but you'll see some of the companies that sit in there. Taiwan Semiconductor, so massive manufacturer of computer chips. Samsung, the major phone company. Then the Chinese companies like Tencent and Alibaba, which are kind of like Amazon and those other similar companies. So they're coming back. They're still well held, but they're still selling at way lower multiples than the US equivalent. If ever they come back to those high multiples, emerging markets will come back with a vengeance. So still an important part of the portfolio. Gold does the opposite of everything else. So you'll see as everything else has been going up, gold comes down a bit, not dramatically, so which is nice, but it did its job. A 1 year return, a very solid 17% to the end of November. So even with the little slight downtick in December, it's still going to finish the year about 14 to 17%, depending on the last week. So a solid contributor. With the property markets, our property clock, and I'll talk through that in a minute, but just looking at what's happening at the moment. So the monthly change in capital cities, we saw Sydney and Melbourne stabilise after a very strong year, particularly for Sydney. So on the right-hand side, you'll see the annual 12-month change. Sydney's a remarkable place. It went up 10% in the last year, even though many of us would think it's expensive, and it's purely supply and demand, and particularly in the areas where people don't have big mortgages. So those secondary markets where you've got more established homes with lower mortgages. So Sydney's had a great year. Melbourne more modest. Brisbane 12.3% for the year. Adelaide 8.6%. Perth 14.5%. So Perth the best out of all the capital cities, which is nice for some of our clients that have invested there in the last little while. Monthly change, Perth still solid. And you'll see the graph down the bottom shows the monthly change as it's moved through. The yellow dotted line there is the overall index for the whole country. Now, it's an interesting index, but you can't buy it because it's made up of all the different capital cities. But it shows that we're pushing 200 there. We're back to the highs of about a year ago after a bit of weakness, but it's very state dependent. And you can see the differences in the states across the top there, or the capital cities. So, and once again, even within those capital cities, there's many different markets. So rentals is part of the story. So two big stories here, massive rent increases. So look at Perth, 13.4% rental increase, Melbourne 11.3%. That's going to underpin their markets. It's unlikely to go up by that, which is a good thing for the renters, bad thing for the landlord, but the landlords are being well rewarded at the moment, and property investors. So yeah, 8.1% across the country, 9.7% in the capital cities, only 4.1% in the regionals, which is interesting. It shows that this shortage, or the property crisis, you'll hear people talking about it, is more exaggerated in the capital cities, which makes sense. But still, regional WA and Perth are still really strong rent increases, as is Melbourne. And Melbourne and Sydney are often the first port of call for immigration. And as we mentioned last month, immigration will hit about 600,000 people this year. Part of that is just a double up post-COVID, where students were returning. So students all left, the majority. So just them coming back is half of that population growth. The rest is the normal immigration growth, and it's going to steady back into that 200,000 to 300,000 people a year after this year. So what does that mean? Well, what's happened with mortgage rates first? So nothing really. So given that no rate moves, but you'll see they're still in that mid sixes. Fixed rates and variable rates still all about the same. There's no major difference between any of the fixed rates. So we're still ambivalent about whether people fix or not. And the only real reason to fix is if you thought rates were going to go massively higher, or if you really just want to insure. But the reality is rates will probably go lower, and it'll be interesting to watch the fixed rates over the next year. Sometimes the fixed rates will be the first to drop as the banks start to anticipate what rates might likely to be, and that will give some welcome relief. And keep in mind, there's still a whole bunch of loans that were fixed in this ditch down here at around 2% that haven't come out yet. So, the 5-year fixed rate We were talking to someone the other day who's still got one of those fixed at, in 2021, the 5-year rate was about 2.6. So some of those people have still got those low rates until 2026. They won't get them they won't get them done at that when it comes out, but hopefully it's back into that 4 to 4.5%, which will provide some welcome mortgage relief to those that are paying those numbers. And that would provide a stimulus to the economy as well. So our friends at Performance Property have made some slight tweaks to the layout of their property clock this month. So they've added a segment here called Peak, and they've changed the name of one of them to Downside Risk. So you'll see there, places like Sydney have that downside risk to stagnation. Now, Sydney surprised everyone last year. No one was really expecting 10% increase in Sydney. It can surprise again. None of this is a science. It's smart people's best estimates, but the markets are constantly moving and constantly sensitive to what's going on the ground. Still have places like Perth and parts of regional Queensland as good buy value and momentum, and we're still very comfortable with that. And even though places like Brisbane and the Sunshine Coast are on hold, there are markets within markets where there is opportunity. And this is more about the shorter to medium term price predictions. And for quality, let's call it the blue chips on all these things. In the long run, people invested in those areas will get great returns. This is just more likely what happens in the next few years. So for those trying to acquire properties before they go up, buying them in the buy value or momentum, I would point out that we don't love properties outside of kind of a 2-hour drive around capital cities. We prefer the robust nature of the capital city markets and anywhere within a 2-hour drive over regional areas. There's a lot more volatility, a lot more danger in regional areas. Looks like a lot of value in some of those at the moment, particularly around units and things like Perth and Rocky, Mandurah. We'd be more comfortable with Perth than those other ones, just given what I said. But yeah, certainly the year has turned out okay. And hopefully you'll forget about markets and everything else and enjoy a fantastic Christmas. I'll wrap up, as always, with that we think investing is best done as part of a real plan. That's where you've got goals based on your life. Portfolio is designed to meet those goals where we take a long-term view. All the boring stuff, diversification, asset allocation, liquidity, the care portfolios have had a good year. We sit comfortably in the top 10 to 20% of comparable portfolios at a reasonable to lower cost than the average. So very happy with the way they've done, but always vigilant as to the changing economies. Low cost, so we find our costs have been held low. We're seeing increases in costs of other areas, including industry super funds. So all of a sudden, we are well and truly in the low cost part of the sector at the moment. And we do protect against short-term volatility with reserves for our retired clients. And as I said, proactive management of those reserves at the right time has made those clients money as we rebalance this time by not rebalancing when markets are down. And dollar cost averaging, what a year for dollar cost averaging. We're going to finish higher than where we started, and we've had ups and downs. So brilliant for our wealth accumulators who are still buying every month. Lots of discounts this year, so a good year for dollar cost averages. And then the boring stuff, rebalancing regularly. As always, our exciting life, boring money process is underpinned by that there's only 3 ways to lose money in the market. That is panic and sell, having to sell at the wrong time and not properly diversified. And happy to say our clients are wonderful in sticking with their guns on that. So it's going to turn out to be an okay year. I know it's not finished yet. I shouldn't put the moz on it. But once again, wish you all a fantastic Christmas and a great new year, and look forward to catching up in the new year. Until then, Rob McGregor signing out.